Hi, I'm Jeff Reeves, the editor of InvestorPlace.com. I'm talking with Jeff DeMaso, the co-editor of the Independent Advisor for Vanguard Investors, and Jim Lowell, the editor of Fidelity Investor. Guys, most investors that are out there, they get started kind of small. They get started with mutual funds, perhaps in an IRA or a 401k. So what do your products provide, Jeff, that allow those entry-level investors to kind of get comfortable with Vanguard and get comfortable with owning funds and building a portfolio?
Yeah, I mean, investing through a 401k is great. We always recommend people try and max out as much as they can to their 401k, or at least up to the point where the company will match. A lot of companies will match your contributions. And so 401ks are great. They get you investing. You're going to be adding regularly. You can do it automatically through your paycheck. So every 2 weeks, every month when you get your paycheck, it automatically goes in. You're automatically adding to your investments. You're forced to take a long-term time horizon with it. And you're going to be compounding your returns without the impact of taxes. So we really encourage people to use their 401ks. With Vanguard, if they're your provider, you're probably going to get indexes are going to be a heavy dose of your choices. Sometimes you'll get lucky and you'll have some of the best of their active funds as well. But being in a diversified low-cost index fund over years and decades isn't a bad proposition.
Yeah, Jim, it's said that Einstein said the most powerful force in the universe is compound interest, right? There's no better way to save for your retirement than to save early and save often in a 401k, right? I've
heard Einstein was pretty smart. The 401k business has been dominated by Fidelity since its inception. If you're sitting in a plane, chances are at least a third of the people on that plane have a Fidelity 401k plan, had a 401k plan at Fidelity, or are thinking about starting a 401k plan at Fidelity. The key guidance that we give is a specific section for members called 401k Focus, where they send us their actual 401k plan menu, and then we create 3 model portfolios that help those members then better invest in their actual 401k plan. We definitely take the newsletter approach, concentrated portfolios, built on what we think are the best of breed choices among their menu. Oftentimes we see menus with no Fidelity funds on them whatsoever, but they're still within a Fidelity 401k plan. The trend is to see about 50% of the fund options be Fidelity funds and 50% be non-Fidelity fund options. But we know our members still need better guidance than just generic 401k advice.
So Jeff, some employers have actually taken to automatically opting employees into certain funds in their retirement plans, including target date funds. They're very fashionable because they put a magical little number up there and they tell you you're going to retire in 2035 or 2040. We're going to adjust your allocations accordingly with that date in mind. Is this a good idea or a bad idea? Are those always the right option for investors in their 401k to go with a target date fund?
I'd say they're a decent option. They're kind of a, simplest. I don't have to think about this one decision and I'm done for my life, which Vanguard and Fidelity and the fund companies love you to make that decision. You're just in it.
As long as those fees keep coming in.
They will, and they'll keep coming every year. With Vanguard, the target retirement funds are just index-based, so you're just going to get a mix of Vanguard total stock market, total bond market, international stock, and international bond as well. And it's just going to gradually bring you down towards more and more bonds and fewer in stocks. We think investors can do better. We think picking the best of the actively managed funds at Vanguard are still going to be low cost, but they're going to run circles around those indexes. The model portfolios within our newsletter have done that for decades, and we think that strategy is going to be a winning one going forward as well.
Jim, even if you have a long-term time horizon, I think it's 59.5 is when you can take your money out of your 401k. Even if you have a long-term time horizon, that doesn't mean to take the old Ronco line of set it and forget it, right? You need to stay active and adjust it not just based on where you are in your life, but also what your personal goals are, right?
No question about it. As Jeff said, you could definitely create a better, more active, and more tailored portfolio using the newsletters and our independent advice than you could just by going to Fidelity and buying that life cycle fund. We know, because we compare our performances of our model portfolios versus the target funds and versus the life cycle funds, that we're able to outperform them year in, year out. For investors, they are a good stopgap option. I'd much rather have people invest in a target fund than nothing at all. Our grandfathers invested in passbook savings accounts. 401ks are the new savings vehicle for America's retirement. You definitely don't want to be in cash for 30 years.
Yeah, and to that point, with the target retirement funds, as you said, 2030, 2035, you're done, you're retired. You're going to be invested exactly the same way as everybody else in that fund. Just because you retire then doesn't mean you're in the same place financially or your ability to take risk or your goals. So it's kind of silly to think that just because you retired at the same time that you should be invested exactly the same way.
Very good advice, guys. Everything a 401k investor needs to know, and there'll be more investing advice on InvestorPlace.com.